So, I always start my lectures by imploring of you to read the chapters. Okay, you need to read the chapters. In this lecture, we're going to look at, if you're using the Warren Reeve and Duchak book, the 12th edition, it's chapter 3. If you're using another book, we're looking at the adjusting process. The adjusting process. Now, I'll start by telling you that there's a concept in accounting called the accounting period concept. The accounting period concept, okay? And that requires that revenues and expenses be reported in the proper period. All right, I'll give you a quick example. Let's say you use electricity in the year 2014 and you incur a cost for using that electricity in 2014. You cannot decide that you're going to record that cost in your accounting records in 2015. That's illegal. You used it in 2014, you incurred the cost in 2014, it must be recorded in 2014. That is basically what the accounting period concept is about. Now, here's where it gets a little bit technical, but not too technical. Remember I discussed in class, and if I didn't discuss it in class, you should have read it by now, that the accrual basis of accounting is different from the cash basis of accounting. And what do I mean is that even though we performed a service, and we know by now that when we perform a service, we've earned fees or we've earned revenue, and we need to record that revenue. But just because we've earned that revenue doesn't mean that we receive the cash. It doesn't mean that we receive the cash. Okay? On the flip side, just because we've incurred expenses such as electricity or rent, it doesn't mean that we paid cash for these expenses. Okay? It could be accrued, meaning that we are yet to pay it, or we're to pay the expense, or we're yet to receive the revenue that we earn. And that's what the accrual basis of accounting is. And the accrual basis of accounting just says that even though you earn revenues but you haven't received the cash yet, you still need to record the revenues in the period where you earned it. So whatever year you earned it in, or whatever accounting year that you earned that revenue in, you need to record it then. You cannot wait to a future period when you receive the cash. So let's say the customer doesn't pay you until 3 years from now. You can't wait until 3 years from now to put that revenue on your accounting records or in your accounting books. Okay? Similarly, if you incur an expense now, you can't wait until you pay it to record it in your accounting records. You need to do it in the period in which it was incurred or earned. Okay? And that's what accrual accounting is. And it's different from cash accounting. We're not going to be looking at cash accounting. Cash accounting means that we record the entries in our records when we receive cash or when we pay cash. That is not generally accepted accounting principles. GAAP. It is not GAAP, so we're not going to look at it. But I just wanted to mention it. So there's the revenue recognition concept, which I mentioned already. And that basically says you need to record revenues in the period which you earned it. And there's also a matching concept or a matching principle, which says that you need to record your expenses in the period when you incurred them and when you earn specific revenues. Okay? So, we're going to look at this adjusting process. And under this adjusting process, we're looking at 5 main things: prepaid expenses, unearned revenues, accrued revenues, accrued expenses, and depreciation. And I'm going to explain what each of these means. I'm going to give you some examples, and we're going to record them in our accounting records. But before I do that, I want to explain to you, why do we need an adjusting process, and what is the adjusting process? When we did the last lecture, we talked about the fact that sometimes we prepay for insurance. So we might pay for 12 months worth of insurance up front. That's called a prepayment, and we put it in an account called prepaid insurance. Remember that? Okay. Now, if we leave that amount in our prepaid insurance, whatever we paid for our insurance up front, if we leave that amount in our account after a certain amount of time, that balance is not going to be accurate. I'll pull up an example here. Our prepaid insurance account now has $2,400 in it. And let's say that I prepaid my insurance for a year. Okay? After 6 months, I do not have $2,400 of prepaid insurance left. I've used up some of that insurance. So now my balance in my prepaid insurance account needs to be less to show that I used up some of my prepaid insurance. Okay? That's what the adjusting process is. So we need to make an adjustment to this prepaid insurance account to show that we used up some of the insurance and this is no longer the correct balance. So that's what the adjusting process is all about, and that is what we're going to be looking at in this chapter. Let's start with prepaid expenses, of which prepaid insurance is one of them. Okay? Insurance is an expense to our company. Okay? Insurance is an expense to our company because we have to pull out some cash and pay for it. Okay? Now, we mentioned in earlier lectures that we can prepay for the insurance. So because it's an expense to our company, but because we're prepaying for it, meaning we're paying all the money up front even though we haven't incurred the expense yet, it's called a prepaid expense. Okay? So, at the beginning of the period, remember, when we make the prepayment, we are going to, let me just find it here. When we make the prepayment, we're going to debit our asset account, okay, because prepaid insurance is an asset. We credit our cash. We credit our cash, okay? And if you look at the journal, this is number 1. If you look at the journal, just in case my screen is blurry, look at the journal that I provided, and if you look at journal entry number 1, you see a debit to prepaid insurance and a credit to cash, $2,400. So when we prepay for our insurance, which is a prepaid expense, we make a debit to our prepaid insurance, a credit to cash. When I go to my ledger, I'm going to do the same thing. I'm going to make a debit for $2,400, and I'm going to make a credit to my cash account for $2,400. So the debit goes in my prepaid insurance ledger account, which is represented by a T account, and a credit to my cash for $2,400. Now, let's say that this was in June. Let's say that I prepaid for my insurance at the beginning of June. Okay? Now, at the end of December, let's say that my year ends in December. December 31st is the end of my year. So I need to record all of my entries that pertain to the year up until December 31st. Now I prepaid my insurance on June 1st. I prepaid my insurance on June 1st. So that means how many months of insurance have I used? I used June, I used July, August, September, October, November, December. So that's 7 months worth of insurance. Again, June, July, August, September, October, November, and the entire month of December. 7 months worth of insurance I used. So what I'm going to do next is I'm going to figure out how much insurance did I use for that entire period, 7 months. Now I know that I prepaid my insurance for $2,400, and I'm going to bring up my calculator. I prepaid my insurance for $2,400, and that was for 12 months. That was for 12 months. So I'm going to divide it by 12, and my insurance amount is $200 per month. My insurance amount is $200 per month. Now I'm going to multiply that by 7 because I prepaid it in June and I've used up insurance for 7 months. So multiply that by 7 and I have $1,400. I have $1,400. So I have used up insurance in the amount of $1,400. Okay? So now what I'm going to do is I'm going to make my journal entry. So I'm going to come to my journal. I'm going to come to my journal. I'm going to put this as A. Oops, the screen slid. I'm going to put this as A. Okay? And I know insurance is an expense to my company. I know insurance is an expense to my company. And we said in earlier lectures that expenses, when we add them to our accounting records, they have a debit entry. So I'm adding insurance expense to my accounting records, and it has to have a debit entry because when I remember our rules back when we did the last lecture. In order to add an expense to my accounting records, I make a debit. In order to remove an expense from my accounting records, I make a credit. So I'm adding this expense called insurance expense to my accounting records. And I just calculated that it's $1,400 for 7 months. Okay? I forgot to put the word expense here. So insurance expense. Okay? Now, I also talked about in the last lecture, for every debit, there's a credit. I'm increasing my insurance expense because I incurred this expense. What do you think I'm decreasing? Yes, I'm decreasing my prepaid insurance. Okay? Because it's no longer prepaid insurance. So remember, prepaid insurance is an asset. To increase an asset, I debit it. Now I'm decreasing my prepaid insurance because I've used up some of it. So to decrease my asset, what do? I make a credit. So in my journal, I'm going to make a credit to prepaid insurance to show that it has reduced. $1,400 for 7 months. Okay? Now whatever I do in my journal, I'm going to do in my ledger. So now I go to my ledger and I'm going to go to my prepaid insurance account and I made a credit in my prepaid insurance account. I'm going to start it down here for $1,400. I made a credit in my prepaid insurance account for $1,400. Okay? And I made a debit in insurance expense account. I do not have an insurance expense account here. So I'm going to create it. So I'm going to create an account called insurance expense. And I'm going to put a debit of $1,400. And I'm going to put these in different colors so we differentiate them from what we did in the last chapter. Okay? So that's my adjusting entry for my prepaid expense called prepaid insurance. I used 7 months worth of insurance. Since I prepaid $2,400 for 12 months, I divide 2,400 by 12. That gives me $200 per month. And I've used up 7 months worth of insurance. June, July, August, September, October, November, December. So I multiply 200 by 7 and I get my adjusting entry. My adjusting entry is going to be a debit to insurance expense because I need to add that expense to my accounting records. And I'm going to decrease my asset, which is prepaid insurance, because I no longer have that asset. I used up that asset in the amount of $1,400. So now you see, if we come here and we balance this account, so I'm going to put my double lines. Remember, this is an asset account, and asset accounts usually have a normal debit balance. So I expect this account to have a debit balance, okay? So I know that it started out with $2,400 in the account, the prepaid insurance account. And I used up $1,400 for 7 months worth of insurance. And now I'm left with a balance of $1,000. Now I'm left with a balance in this account of $1,000. Okay? So I have done the adjusting entry to my prepaid expense account. And this is what this chapter and this lecture is all about. And we're going to do this for a few more accounts. Okay? So that's prepaid expenses. Next are unearned revenues. Unearned revenues. And I think we might have done something on this before. And let me just look through here quickly. Yes. So if we look at journal entry number 3, journal entry number 3 in our journal that we did in the last lecture, you saw that we were renting a parking lot. We were renting a parking lot to someone, and they prepaid us. They prepaid us for the rent. We have not provided the rent service yet. They're not using the parking lot yet. So really, they have not used up the benefit yet. So we have to put it in an account called unearned rent. We have to put it in an account called unearned rent. So if you look at journal entry number 3, we credited unearned rent for $360 because unearned rent works the same way as revenue. Even though we haven't earned it yet, it is still revenue. Okay, so, and we know revenues, in order to add them to our accounting records, we make a credit. And then the way how we do a prepayment is by cash. So we receive some cash, we made a debit to increase our cash for $360. Now let's say that this happened at the beginning of December. And just for your information, I'm not following the sequence in the book. I'm not following the sequence in the book, okay? I'm just giving this lecture on the adjusting process, all right? So with that said, let's say that this prepayment of rent was made to us at the beginning of December. So whoever the client is that wanted to rent our parking lot, they have not used our parking lot yet, but they just prepaid us. That was on December 1st. Now, at December 31st, when we are closing our accounting records, so we have to end our year on December 31st and make all of our accounting records, this client would have used up 1 month worth of the parking lot. They used up 1 month worth of the parking lot. Okay? So, here's what we do. Let's make our entries first. I'm going to call this journal entry B. I'm going to call this journal entry B. When they prepaid us and they did not use the benefit, it was unearned rent. Now that they've used up 1 month worth of the benefit, we have earned that rent. We have earned that rent. So now I want to add the amount that I've earned to my fees earned account. Because I've earned it. It's no longer unearned rent. It's earned. So I'm going to add it to my fees earned account. Fees earned account is revenues. And remember from the last lecture, we said that in order to increase revenues, we do what? We do a credit. So for journal entry B, my second adjusting entry is going to be a credit. And remember, I need to do my indentation. So I'm going to do a credit to fees earned. Now I'm just writing down my accounts now, and then I'll calculate it afterwards, okay? But I earned my fees. I'm going to post them to my fees earned account. Now, since I earned those fees, they're no longer unearned. So what do I need to do? My unearned rent account cannot remain at $360. It cannot remain at $360 because I've now earned some of those fees. So I need to reduce that account. And remember, the unearned rent works the same way as revenues. So in order to increase it, we credit it. In order to decrease it, we debit it. And we want to decrease it. So I'm going to make a debit to my unearned rent account. Okay, so the entries that we're going to make, I want to reduce my unearned rent account because I've earned those fees. So I'm going to debit my unearned rent account to reduce it, and I'm going to credit my fees earned account to increase it. All right. Now that 360, this 360, if I remember correctly, it was for 3 months worth of using the parking lot. This was for 3 months worth of using the parking lot. So I'm going to go to my calculator. If 360 was for 3 months, I have to figure out how much it is for 1 month. So I'm going to divide the 360 by 3, and I get 120. So 360 is for 3 months, 120 is for 1 month. I just divide the 360 by 3. Okay? Now, I said that I've only used up the client has only used up 1 month's worth of rent. So the amount that I'm going to debit and credit is 120, 1 month worth of rent. And I have adjusted my unearned revenues account. Okay? So I've done my adjustment to my unearned revenues account. Now, remember, whatever I do in my journal, I have to do in my ledger. So I'm going to go to my ledger. I'm going to look for my unearned fees account, which is here. You see it has a credit of $360, and then I just made a debit of $120. So I just made a debit of $120. I'll highlight it in red. And now I'm going to balance this account again. I'm going to figure out the new balance of this account. So remember, unearned rent is the same. It works the same way as revenues, and revenues have a credit balance to increase them, they have a credit entry to increase them, and whichever side increases the account, we say that that is the normal balance. So unearned rent is increased by credits. It has a normal credit balance. So I would expect this account to have a credit balance. So I'm going to go to my credit side, and I'm going to take my $360, which is the balance in this account, and I'm going to subtract the $120, and I'm going to be left with $240. So now I've earned $120 worth of rent, but I still have $240 that I have not earned yet, because the tenant who's using the parking lot that I'm renting to him or her only used up 1 month worth of the benefit. Okay? So I made that an entry in my unearned rent account. Now I'm going to go to my fees earned account, and we made a credit to fees earned, so I'm going to put another credit here for $120, and then I'm going to balance this account. So I started out with a balance of $8840, and now I'm adding $120. So the new balance in this account is $8960. $8960. Oops. Let me just go back and highlight it. Am I doing it right? Here we go. Okay? So whatever I did in my journal, I did in my ledger. And notice we're using the same accounts from before. You do not create a new set of accounts, okay? You do not create a new set of accounts for the adjusting process. All right, so we've knocked out prepaid expenses and we've knocked out unearned revenues. Now let's look at accrued revenues. Accrued revenues. Now, accrued revenues are simply when you have performed a service to someone. You've performed a service to someone. So if you're an attorney, you perform legal services. If you are a rental agency, they've used up the benefit of renting that apartment or that office or that building for a certain number of months, okay? But you have not recorded it yet in your accounting records. You have not recorded the revenues that you earn in your accounting records, so we call them accrued revenues. And the reason that you probably haven't recorded them is because you probably haven't billed them yet. You have not billed your client. So you have not sent a bill to your customer that you're representing as an attorney, or to your tenant in your apartment or your office building, okay? But remember, we have these concepts, the accounting period concept and the revenue recognition concept, which says that when we earn this revenue, we must record it in the correct period. So let's say we earned some rent as of December 31st. So I'm going to create a new scenario under here. So let's say as of December 31st, and I won't put a year, but you can say 2014, we have earned, let's say, $3,000 of rental income, which needs to be billed to customers. So as of December 31st, we have earned $3,000 of rental income, which needs to be billed to customers. This is what we call accrued revenues. We've accrued it. We have not recorded it yet. Okay? Here's how we will record it. I'm going to go to my journal. I'm going to put C. So I'm going to do in my adjusting entry C. All right? Have I earned these fees? Yes, I've earned them because I performed the service. Okay? So I need to increase my fees earned account to show that I've earned these fees. So I'm going to make a credit to my fees earned account. And the amount is $3,000. Remember, I just said $3,000 in the scenario. Now, since I have not yet billed these customers, which means they have not yet paid me. I've not billed them, they have not paid me. If they haven't paid me, but I performed a service, they owe me. And we know that when someone owes us money, what do we call it? Account receivable. So I'm going to make a debit to increase my account receivable amount, $3,000. So I have increased my asset, $3,000, and I've increased my fees earned, $3,000. This is what we call accrued revenues. This is what we call accrued revenues. And remember, whatever I do in my journal, I'm going to do in my ledger. So in my ledger, I'm going to look for my accounts receivable, which are here. So I look for my accounts receivable, and I do what? I add my $3,000. I make a debit to my $3,000 because I made a debit in my journal. Whatever I do in my journal, I do in my ledger. So I've made this debit for $3,000, and I'm going to balance this account again. So I had a balance in here of $22.20, and now I'm adding $3,000. So the new balance in my journal, the new balance in my ledger, my accounts receivable is 5220. So the new balance is 5220. Let me just make sure I save this. And then my fees earned account, I've added some more fees, right? I've added some more fees. So let me just do this. So I'm going to go to my fees earned account, and I'm going to put $3,000 here. I'm just going to go back and put $3,000. All right? And I'm going to adjust this because it's no longer $89.60 because I've added $3,000. So it's the $88.40 plus $120 plus $3,000. So that's the new balance in this account, $11,960. So my fees earned account has a new balance of $11,960 because I added in the $3,000. Okay? And that's my accrued revenues. All right? Next are my accrued expenses. Accrued expenses. So accrued expenses happen when I have incurred an expense. I've incurred an expense, but I have not yet recorded it in my records. Remember the accounting period concept and the matching principle, they say that I need to record these expenses when I incurred them. I cannot incur electricity costs in 2014 and record it in 2015. It must be recorded when it has been incurred. So I'm going to make up another scenario here. Let's say that as of December 31st, we have incurred, let's say, rental expense of $10,000. We have incurred rental expense of $10,000, okay? This does not talk about us paying it. It does not talk about us paying it. It just says that we incurred it as of December 31st. I need to record that in my records. So I'm going to go to my journal, and I'm going to do my adjusting journal entry D. Adjusting journal D. Okay? Now, I've incurred some rent. That's an expense. So I'm adding an expense to my accounting records. I am going to debit rental expense, because remember, in order to add an expense or increase an expense in our account and records, you must debit the account. So I'm going to add a debit to my expenses, $10,000. Now it said that I incurred this expense. It doesn't say anything about me paying it. So if I've incurred it, I did not pay it, but I have to pay it, that means that I owe somebody. That means that I owe somebody. Remember, we said when we owe someone something, we call it a payable. So I'm adding a liability, or I'm adding a debt to my accounting records because I owe someone this rent. So I'm going to put it in my accounts payable. Okay? You can also put it in a rent payable account, but let's just keep it simple for now and put it in accounts payable. So I'm adding this liability or this debt to my account. And remember, in order to add a debt to my accounting records, I need to make a credit from our last lecture. So whatever I do in my journal, I need to do in my ledger. So I'm going to go over here. I'm going to look for rent expense. And I do not have a rent expense account. So what am I going to do? Yep, create it. I'm going to create my rent expense account, and I made a debit of $10,000 in the journal. So I'm going to make a debit of $10,000 in my ledger. All right. Now, the credit was to accounts payable. So I'm going to go to this account payable here. I'm going to go to my account payable here, and I'm going to make my credit for $10,000. So I'm going to make my credit for $10,000, and I'm going to do the new balance of this account. So the new balance of this account, I had a debit of $400, and I have a credit of $10,000. So I subtract these two numbers, and that gives me a new balance of $9,600. Let me just take out a line from here. All right, so that gives me $9,600. All right. Now, that is my accrued expense. That's my accrued expense, okay? I want to do, well, no, that's my accrued expense, so we'll leave it at that, all right? And this can happen for any expense. It could be a utility expense, rent, taxes, anything. As long as we incurred the expense in this period, it needs to be recorded in this period. But we haven't paid it yet. So it's going to be a payable. The last one I want to go through is called depreciation. Depreciation. As we buy our assets, and as we use up our assets, they lose value. The most popular example is a car. We all hear that when you buy a car, as soon as you drive it off the lot, it depreciates. The value goes down. Same thing happens in a real business. The value of the assets go down. Most assets, not all assets, okay? When the value goes down, we call it depreciation, okay? So let's do a scenario. Let's see what we have here. We have some equipment, office equipment. So let's say we bought this office equipment and now it has depreciated. So as of December 31st, office equipment has depreciated $400. So our office equipment has depreciated $400, okay? Depreciation is an expense to my company. Depreciation is an expense to my company. So here's what I'm going to do. In my journal, I'm going to create E, adjustment E. And since I'm adding an expense to my account and records, I'm adding an expense called depreciation. I'm going to debit that account. Remember, to add an expense or to increase an expense, we make a debit. So I'm going to add depreciation expense, debit $400. Okay? Now, the credit, you're probably not going to know this, but I'm going to tell you. We make the credit to an account called accumulated depreciation. Okay? So, accumulated depreciation. That's what we make the credit to. All right? And you can add office equipment onto the end of this name so you know that this belongs to, I'm going to just put it on the next line. I'm going to put office equipment so that if you have multiple assets and you depreciate them, you know which asset the depreciation belongs to. And the accumulated depreciation has a credit entry. It has a credit entry, okay? So whatever I do in my journal, I need to do in my ledger. So I go over to my ledger. I do not have those two accounts. I do not have those two accounts. So what am I going to do? I am going to create them. So I'm going to create my depreciation expense account, and I made a debit of $400. Depreciation expense, I made a debit of $400, and I'm going to create my accumulated depreciation office equipment and I'm going to make a credit of $400. I'm going to make a credit of $400. And this is a little bit too long, so let me see how I can get it to fit. So it doesn't allow me to... Okay, there we go. So my accumulated depreciation, office equipment, a credit of $400. Okay? Alright. That's my depreciation. So we've looked at all of these categories under the adjusting process. And this is what this chapter and this lecture is about. Now this chapter doesn't go into this, but I want to also do this. You will look at this in chapter 4, and if you're not using the Warren Reeve and Duchak book, you'll hear me talk about it in the next lecture, which is lecture 4. Okay? But as you see here, we have some new balances in our accounts. Some of our accounts have changed. So let's go through and make sure all of them have balance. So I have a balance in my prepaid insurance account. I have a balance in my cash, a balance in my prepaid rent, a balance in my unearned rent, a balance in my office equipment. So all these accounts are balanced. My insurance expense account is not balanced over here. My insurance expense account is not balanced. So I'm going to balance it. It has one entry on the credit side. So that's what my balance is going to be. $1,400 in my insurance expense account. All right, I'm going to highlight it just so we know. My rent expense also needs to be balanced. So that's going to be $10,000 on the debit side. So I'm going to balance that account as well. All right. Let's see. Anything else needs to be balanced? My depreciation expense account needs to be balanced. So that has a balance of $400 because that's the only entry in there. So I'm going to balance it with $400. And last but not least, my accumulated depreciation needs to be balanced. Credit balance of $400. Credit balance of $400. Okay, so now all my accounts are balanced. All my accounts are balanced. Okay? So now the next step that I want to do is I want to do an adjusted trial balance. So what we did in the last lecture was actually called an unadjusted trial balance because we did not have any adjustments. Now that I've made my adjustments to these accounts that need to be adjusted, I'm going to create an adjusted trial balance. So I'm going to have an adjusted trial balance. And all that means is that now that I've adjusted the accounts that need to be adjusted, I'm going to write out all the balances again. Okay? So all I'm going to do is copy all of these from here. I'm going to copy all of these from here so that I don't have to rewrite them or retype them. Alright, and you probably have to just rewrite them if you're doing this. And my copy paste function doesn't seem to want to work. So let's try this again. So there we go. There we go. Okay. So I'm going to have my account name again. I'm going to have my debit and my credit. Okay. Now, even though I copied these balances, I'm going to erase them because these balances are not all correct. These balances are not all correct. So I'm going to erase these, and I'm going to go back and look at the new balances. So, back to my ledger. My prepaid insurance now has a balance of $1,000. So I'm going to do a debit of $1,000 in my adjusted trial balance. My cash did not change. 3635 on the credit side. 3635 on the credit side. My prepaid rent did not change. 800 on the debit side. My unearned rent, that balance changed. Now it's 240 on the credit side. So now it's 240 on the credit side. My office equipment did not change. So that's $1,800. It did not change. $1,800 on the debit side. My account payable to executive supply did not change. So that's still $900 on the credit side. My miscellaneous expense did not change. 180 on the debit side. 180 on the debit side. My account payable, that changed. That's now $9,600 on the credit side. So I'm going to put that as $9,600 on the credit side. My wages expense, that did not change. $2,150 on the debit side. $2,150 on the debit side. My fees earned, that changed. That went up to $11,960 on the credit side. So $11,960 on the credit side. My accounts receivable, that changed as well. $52.20 on the debit side. So I'm going to put that $52.20 on the debit side. My supplies did not change. $14.50. $14.50 on the debit side. My utilities expense did not change. $5.35 on the debit side. My dividends did not change. $1,800 on the debit side. $1,800 on the debit side. Now, do I have all my accounts? The answer is no, because I created some new accounts. So since I created new accounts, I need to add them to my trial balance. So I'm going to go back to my ledger, and I see that I added insurance expense, $1,400 on the debit side. So I'm going to type that here. Insurance expense, $1,400 on the debit side. I added rent expense, $10,000 on the debit side. So I'm going to add that to my trial balance. Rent expense, $10,000 on the debit side. What else? I have my depreciation expense, $400 on the debit side. So I need to add that. Depreciation expense, $400 on the debit side. And last but not least, I have accumulated depreciation office equipment, $400 on the credit side. So accumulated depreciation, and under here I'm going to put office equipment, $400 on the credit side. Do I have all my accounts and the balances? Yes, I do. Alright, so now I'm going to balance this. So I'm going to put my fancy double lines, which shows that this is the ending balance. And I'm going to add up everything under the debit side. So equals the sum of everything on the debit side only. So I add up all of those. And I get $26,735. And now I'm going to add up everything on the credit side. So sum of everything on the credit side Also 26,735. So I am in balance. All right? And that's the adjusting process. Now I just want to go over a few more things that can be adjusted. A few more accounts that can be adjusted. Let's look at our ledger. Now my prepaid rent can also be adjusted. So just like prepaid insurance, I pay for a certain amount of rent up front, and as I use that benefit, I need to record the expense. So let's say that we actually used up some of this prepaid rent. What would I do? I would need to make a credit to this account and a debit to my rent expense account. Okay? So let's say I used up some of the $800 in my prepaid rent account. In order to show that I used it up, I need to decrease that account, right? And to decrease an asset, I need to make a credit. So I would make a credit for some amount in my prepaid rent account. And since rent is an expense, I would have to make a debit to my rent expense account for some amount. The other one and that's called a prepaid expense. So we did that. That's the same as prepaid insurance, okay? The other one I want to talk about as well is our supplies. So supplies also get used up, okay? So as we use up these supplies, we would make a credit to the supplies account to show that we used up some of those supplies. And we would need to create an account called supplies expense. And we would make a debit for the amount that we used. Okay? Now supplies can get a little bit tricky because the question can give it to you a couple of ways. They can say supplies on hand as of December 31st are $100. Now this is the tricky part. It can tell you that, or it can say we used supplies in the amount of $1,000 as of December 31st. Now these require different thought processes. So let's look at the first one. Supplies on hand as of December 31st are 100. What this is telling you is that I only have $100 worth of supplies in my account. So it's telling you what the balance of that account is. So under your supplies account, you need to create your ending balance. Of 100. Because that's what it's telling you. It's telling you that $100 worth of supplies remain. It doesn't tell you that we used up $100. It doesn't say that we used 100. It says that we used up a certain amount and $100 remain. So if we had a balance of $1,450 and now we only have 100 left, how much do you think we used? We used $1,450 minus 100, which is $1,350. So we had $1,450 in the account, we used $1,350, and now 100 remains. And that's what the question can tell you. The question can tell you what remains at the end. So that's kind of a tricky question, okay? So I'm going to erase this, and we're going to do the other one. The other scenario is where it tells us what has actually been used. It says we used supplies in the amount of 1,000. And by the way, I'll put back this 100 quickly here. So if I have $100 remaining and I use $1,350, since I reduced my supplies account by $1,350, I have to make a debit in my supplies expense account of $1,350. Okay? So I'd make the credit to my supplies account for $1,350. And I'll make a debit to my supplies expense account, $1,350. All right? So let's remove that now. So I'll delete that. And let's say it told us that it told us what we actually used. So it says I used $1,000 worth of supplies. So since it's telling me what I used, it's telling me how much I need to reduce my account by. So I need to reduce my supplies account by 1,000. So now my balance is $1,450 minus $1,000, which gives me $450. Okay? And since I made a credit to supplies, meaning that I used up $1,000 worth of supplies, I need to put the expense on my books. And the expense would be $1,000 because that's how much supplies I used, and that's the expense that I incurred. Okay, so that's a little trick to look out for with supplies. Okay? So, that is this lecture. All about adjusting entries.